What's going on, guys, and welcome back to another video. So in today's video we're going to look at 5 companies that I'm going to be looking into this week once the market opens. But before we get into today's video, it'd be great if you're new around here to subscribe to this channel if you haven't done so already, as it would really help this channel out going forward. So as I'm all for diversification and to keep this video a bit more interesting, I'm going to talk about a few different sectors in these 5 companies. So we'll have one company in the electric vehicle sector, 2 in the tech sector, 1 in communication services, and 1 in real estate. So the first company on today's list is WorkHorse Group, which is in the electric vehicle sector, and I made a full video on this company a few days back, which I will link in the description below. WorkHorse Group Incorporated is an American manufacturing company based in Ohio, which currently focus on manufacturing electrically powered delivery and utility vehicles. The company was founded in 1998 and has since took over from the production of General Motors. The company is traded on the Nasdaq and has ticker WKHS, and at time of recording the NAV was $30.60. We can see from the 1-year chart on Yahoo Finance that this time last year the company was about $3.25 a share, and since then it has gone up drastically, especially in July, where it went from, let's say, in May it went from $2.93 to July it went up to the $20 mark. Since July it went back down in August, and in August it went back up and then back down at the start of September, and ever since it has went in an upward trajectory and is currently at $30.60 a share. One of the main reasons that I have this company on the list for this week is because of the USPS contract that is looming, which will have been put in place by the end of this month, and if Workhorse can obtain this contract, it could be worth a few billion to the company, which will certainly drastically increase its share price in the coming years. And probably the second reason that I have this company on the list is because I'm becoming more and more interested in the electric vehicle sector, of which I have not yet invested in. And because everyone kind of goes on about Tesla, etc., I kind of wanted to have another approach and look at other electric vehicle companies, and Workhorse is certainly a contender for one of the best of these companies in this sector. The next 2 companies out of the 5 on today's list are in the tech sector, and the first of these being Apple. So Apple is an American multinational tech company headquartered in California that develops, designs and sells consumer electronics, computer software and online services, and is considered the big tech company. Apple is traded on the Nasdaq and has ticker AAPL, and at time of recording it was $106.84 per share. I've also made a full video on Apple a few days back. Again, I will link this in the description below. And as I said in that video also, when you look at the company's 1-year chart, because of the 4-to-1 stock split that took place a few weeks ago, these shares prices are divided by 4. So for example, this 54 should have been around 216, but because it incorporated in that stock split since then also. So because of the split, each share at the time would have been worth $54.97 a year ago. And as you can see, since the crash in March, it has continuously kind of went up in an upward trajectory, which is very impressive. And it is currently at around $110 a share at the moment. So the 2 main reasons why I'll be looking at this company over the coming week is because, firstly, as I mentioned in the prior video, that it's one of my favorite companies, as I feel that it's extremely innovative and it's definitely the way forward as well for in the majority of the products that they're offering. And because in their last network meeting as well, they mentioned that they're getting to the fitness industry even more, I feel that's going to benefit this company enormously. And the second reason is because the company's stock price has dropped over the last week or two, a few percent. So I'm going to get in on the dip to help downgrade my overall dollar cost average cost on this company. The third company that I'm going to be looking at this week is Facebook. And I know Facebook is technically in the communication services sector, but I like to classify it in my own portfolio as a company in the tech sector. So a lot of people don't like to hear that, but that's just the way I look at the company. Facebook is an American social media conglomerate based in California. Facebook is traded on the Nasdaq and has ticker FB, and at the time of recording, the company's NAV was $252.53 per share. So as we can see from the company's 1-year chart, like most growth stocks, it has been quite choppy over the last 365 days. You can see here that a year ago, it was at $189.93 per share, and even in March, it had a fairly big drop down to $163 a share. But ever since, it's kind of impressively went up in an upward trajectory, and it is currently, well, it went up to over $303, but it has dropped back down to, at the moment, $254. So I believe that because I have done my due diligence on this company, that the current share price is a price that I would be willing to get in. And again, like Apple, this will help drop my dollar cost average amount that I have for this company, which is certainly what you want to be looking for as a long-term investor. So the two main reasons why I'm going to be looking at this company is, number one, that I already mentioned, to make my dollar cost average more respectable. And second of all, because Facebook has a large stronghold, for example, as WhatsApp, Facebook Messenger, Instagram, etc. So there's a huge stronghold in a lot of that kind of sector, which is in the communication services. I know, again, I call it in the tech sector, but I believe Facebook has a huge stronghold overall on this. So that's one of the main reasons. As a long-term investor, this is definitely a company that I feel has a lot more potential to offer in the coming months and even years. Now, the fourth company is in the communication services sector, and it's a company that a lot of people actually aren't really talking about anymore since they scrapped their dividend, and that is Walt Disney. Walt Disney is an American diversified multinational mass media and entertainment conglomerate headquartered studios in California. Walt Disney is traded on the New York Stock Exchange and has ticker DIS, and at time of recording, the stock was at $128.63. Now, as you can see from the company's 1-year chart, these kind of companies were hit very hard during the crash and the crisis. And as you can imagine, with their theme parks being one of their main sources of income, and even things such as movie production, took a giant hit. So you can see at the start of this time last year, it was at about $130 a share, and then dropped drastically down to about $85, again due to the theme parks closed, having to stop movie production, etc. And when that happened, they cut their dividend completely, and I believe that dividend will be back again in due course once the company starts to pick up even more. But since the crash, you can see that I know it had its ups and downs, but overall it is going in an upward trajectory, which is very promising to see, and is currently at $128. As a long-term investor, I believe this is a great company to still get into, because their dividend will come back, which will furthermore increase the demand for this company, which will increase the share price again. So as a long-term investor, I mean even the next 3 to 5 year period, this is definitely a brilliant company that is going nowhere, that the company's price will continue to rise. So again, I'll be definitely buying more of this company. So the fifth and final company on this week's list is in the real estate industry and is Realty Income, which is again 99.9% of people's favorite company in the real estate sector. The Realty Income is a real estate investment trust that invests in freestanding single-tenant commercial properties in the US, Puerto Rico, and the UK that are subject to the NNN leases. So Realty Income is one of those monthly paying dividend companies and has ticker symbol O. It is traded on the New York Stock Exchange, and at time of recording, its NAV was $62.35. So we can see from Realty's 1-year chart that, like the majority of companies, and as you can imagine, because their sole form of income is from renting, and because a lot of these companies weren't open during the crisis, their share price went from, let's say, $78, $77 this time last year, and it dropped even as far down as, say, $42, so nearly split in half. But since then, it has ups and downs again, like majority of companies, but it is starting to go in an upward trajectory again, and is currently at $62.35. Now, the two main reasons why I'm going to be further increasing in my position in this company is number one, it has increased its dividend. So you can see here, 108 common stock monthly dividend increase declared by Realty Income. And the second reason that I'll be adding to this position is to help keep my whole portfolio diversified, as this would be the only real estate company in my portfolio. So with that being said, guys, that brings the end to today's video, and that's the 5 companies that I'll be looking into this week and the reasons behind it. So if you would like this video, it'd be great if you could smash that like button and subscribe if you haven't done so already. And more importantly, comment below on companies that you will be looking into this week and the reasons why. Thanks very much, and I will see you guys in the next video.